Welcome to the Deep Dive, where we take these huge, complex ecosystems and, well, we try to boil them down to what you actually need to know. Today, we're plunging headfirst into the world of startup funding in India. It's dynamic, it can be confusing, but we're here to help you navigate it.
It's an incredibly high-stakes environment, you're right. And our mission today is pretty straightforward. We want to cut through all the noise. We're aiming to give you a shortcut, a kind of demystified guide that focuses on what investors really expect, the practical steps, and the things that are, absolute non-negotiables.
That's the goal. And we know that something like 99% of founders chase money without being properly prepared. So today is about arming you with the checklist and the clarity to be in that top 1%. We'll cover the investor checklist, the 10 major types of capital available, the 7-step playbook from idea to term sheet, and of course, the biggest mistakes to avoid.
And we have to start at the very beginning. Before you even think about where to get the money, you have to understand what the money is actually chasing. People think it's the idea, but it's something much more foundational than that.
Okay, let's unpack that.
Yeah.
I think we all get that it's not just about the idea, it's about execution. So what are these fundamentals? Our guide points to 5 pillars that have to be rock solid.
It all comes down to minimizing risk for the investor. So number 1, you are solving a real problem. Investors don't fund creativity for its own sake. They fund a necessary solution to a painful problem. If it's not painful, the solution just isn't that valuable.
That makes sense. But the second one, market size. This is often a huge hurdle for early founders, isn't it? How big does it need to be?
It has to be massive. And I mean, we're talking about a multi-billion-dollar total addressable market, or TAM. Think about it from their perspective. A small market means small returns. And for VCs deploying millions, small returns means no funding. It's that simple.
Hold on, though. How do you really prove that? For a founder who's just starting out, saying your market is huge, that can sound a bit subjective, can't it?
It feels that way, but you have to quantify it. You show the research, you calculate the total annual spending in that category, and then you show a credible path to capturing a slice of it. It's not about just saying it's big, it's about showing the math. Third is the strong founder and team. This is crucial. Investors are betting on the jockey, not just the horse. They need to see proof that you and your team can actually execute. A brilliant idea with a weak team. It's worthless because they know that idea is going to change.
And it leads right into the 4th pillar, which is the evidence of that execution. Traction or early proof? What does traction even look like for a brand new company? Are we talking millions in revenue?
Not at all. Traction is just tangible evidence that customers want what you're building. It could be a little bit of early revenue, sure, but it could also be high sign-up rates, strong engagement, maybe even just 100 people who absolutely love your product. It lowers the risk dramatically. And finally, number 5 brings it all together. Business model clarity. You have to be able to explain very clearly how you make money, why a customer pays you, and how you get 10,000 more customers to do the same thing. If that's fuzzy, the conversation just stops.
So the big takeaway here seems to be that getting ready for funding is maybe 80% building a solid business and only 20% actually pitching. If your problem, market, team, traction, or business model is weak, no amount of slick slides is going to save you.
Exactly. You need that foundation first. And once it's built, then you need to know which type of capital to even go for. And the menu in India is huge. We've distilled it down to 10 major types.
Okay, let's start with the earliest stages. These are really important because they let you keep your equity before you go to the pros. First up is bootstrapping or self-funding, using your own savings.
Yeah, and investors really respect this. It shows you have skin in the game. And crucially, it avoids what we call equity dilution.
Which is, just to be clear,
it's giving away a piece of your company, a percentage of ownership, in exchange for cash.
Got it. After bootstrapping, what's next?
The fastest method is probably friends and family, but this comes with a huge warning. You must get a legal agreement in place. Document the terms, even if it's your own uncle. It prevents so many problems down the line.
Mm-hmm. And then there are bank loans.
Yeah.
But these aren't for every startup, right?
No, not at all. Bank loans are great for stable, revenue-generating businesses. Think working capital loans, MSME loans. They lend against assets or revenue, not some future hockey stick growth chart. Now we get into the world of equity. Let's talk about angel investors. These are wealthy individuals investing their own money. The checks are smaller, maybe 5 lakhs up to 2 crore, usually at the pre-seed or seed stage.
Yeah, we see figures like Kunal Shah or Anupam Mittal doing this. How is their approach different from a bank's?
It's completely different. They're betting on the founder's passion and the uniqueness of the idea. They're looking for that spark. And often they invest through angel networks, like the Indian Angel Network or Let's Venture, where they pool their money and expertise. That's a great spot for a startup raising their first 50 lakh.
And then you level up to the big leagues, venture capital or VC funds.
Exactly. These are the professionals. They're managing other people's money. The rounds are much larger, from 2 crore up to 200 crore, sometimes more.
We're talking about the big names here,
Hmm.
like Peak, XV, Excel.
Right. And their focus is on maximum scale and growth. The due diligence is incredibly rigorous. This is for when you've already proven your model and you need jet fuel to expand.
Okay, and we can't forget two other key players that offer more than just cash: incubators and accelerators.
And it's important to know the difference. Incubators are sort of for the long haul, helping you flesh out an early idea. Accelerators, like Y Combinator, are intense 3-month boot camps. They give you a little seed money and a structured program to accelerate an already validated idea. The network you get from them is often the real prize.
Now, for a category I think a lot of founders miss, which is huge in India:
Right.
government and public sources.
Oh, this is a massive opportunity. And it's often non-dilutive. The main one is the Startup India Seed Fund Scheme, or SISS. The government backs incubators to give out capital, up to 20 lakhs for a prototype or 50 lakhs for market entry. But the real secret weapon is government grants and schemes. And the reason they're so powerful, you give up zero equity.
Zero equity. That's a game changer.
It is. These programs are about boosting national innovation, not getting a financial return. So if you're in biotech or IT or manufacturing, you have to look into things like the big grant or Tide 2.0.
And the final one on our menu:
Crowdfunding, using platforms like Keto or MillApp. This works best for brands that have a real emotional connection with the public. D2C products, social causes, that sort of thing.
Wow, okay, that is a comprehensive menu. So that shifts us from the what to the how. The actual funding playbook, a 7-step process. Step 1, as you said, is fundamental. Validate your idea with an MVP. Show, don't just tell.
Then comes step 2, where I'd say 99% of founders stumble. Prepare mandatory documents. This has to be perfect. There are 4 key documents you just can't mess up.
Let's break these down, starting with the pitch deck. The advice is to keep it short, right? 10 to 12 slides max.
Absolutely. It needs to cover the problem, solution, your massive market size, any traction you have, your USP, the team, your financials, and the most important part, the funding ask and utilization. If you're asking for 5 crore, you better have a slide that shows exactly where every single rupee is going.
A vague plan for the money is a huge red flag, I imagine.
It signals a lack of discipline instantly. Second document, financial projections. 3 to 5 years. And this isn't just about revenue, it's about proving you understand your unit economics.
Okay, jargon alert. Let's define that, because this is where deals are won or lost. What are the key metrics?
You need to know your revenue, your expenses, your break-even point, of course. But the two that matter most are CAC, customer acquisition cost, and LTV, lifetime value. If it costs you 10,000 rupees to get a customer, but that customer only brings in 5,000 over their lifetime, your business is fundamentally broken. An investor will see that in a second.
So a high LTV compared to your CAC proves that your business engine actually works and can scale profitably.
It proves the engine works. Third, the legal documents. This means your shareholding and cap table.
What exactly is a cap table, and why is a messy one such a deal killer?
The cap table, or capitalization table, is just a spreadsheet that shows who owns what percentage of your company. If it's a mess with confusing old agreements or weird ownership structures, it's a nightmare for an investor. It signals future legal battles. It has to be clean. And of course, you need all your registration docs: CIN, PAN, GST, and so on.
The basic blocking and tackling of running a company.
You'd be surprised how many people don't have it in order. And the fourth thing, obviously, is a product demo or prototype. They need to see it.
Okay, so once the paperwork is perfect, step 3 is to keep building traction. We talked about this, but what's a good milestone?
It's about showing momentum. Real customers, real sales, and especially repeat customers. The guide says even just 100 dedicated paying customers can be enough to get an angel investor's attention.
Then you're ready for step 4. Approach investors, not just randomly, but strategically through LinkedIn, AngelList, or events in your sector.
And that leads to step 5, pitching perfectly. This is about confidence, knowing your numbers cold, and telling the story of why your team is the one to bet on.
After the pitch comes the hard part. Step 6. Due diligence.
This is where they check everything. They audit your financials, your legal docs, they call your references. Everything you said in the pitch has to be verifiable.
And if you pass that, you get to step 7, the term sheet and funding, where you finalize the valuation, the equity, and the money hits the bank.
Usually in stages or tranches tied to hitting specific milestones.
That process is crystal clear. But let's talk about strategy and how to avoid the landmines. There's this non-quantifiable element of trust. The advice is clear: don't raise too early. Keep your valuation realistic and build relationships with investors before you need their money. But all of this seems to build up to one thing: building trust.
That's it. It's so often overlooked. Investors fund people they trust. And this connects directly to the biggest mistakes we see founders make. Think of this as a warning checklist. First, landmine, asking for funding with no product. It's an immediate no. It just shows you're not serious. Second, an unrealistic valuation or being fuzzy on your market size. It makes you look either arrogant or ignorant.
And the documentation errors we mentioned, a messy cap table or poor financial projections, if you don't know your numbers.
You have zero credibility. And specifically, not knowing your CAC and LTV. That's a non-negotiable failure. You haven't done the basic homework on your own business.
And finally, in the pitch itself, only focusing on the idea and not on execution or just being a copycat of another startup. The message is, show them a working vehicle that just needs fuel, not a dream on a napkin.
Exactly. Which brings us to the very practical logistics. The when and the how much.
Right. How much should you actually raise? The guide is pretty specific here. You should only raise enough for 12 to 18 months of runway, plus a small buffer, maybe 10 or 15%.
Yeah.
And that needs to cover salaries, product development, marketing, all your core costs.
Mm-hmm. And just as important is knowing when not to raise. There are 5 clear scenarios where you should just pause. Don't raise if your idea isn't validated. Don't raise if your product isn't ready. And, critically, don't raise if you don't know your own numbers. CAC, LTV, all of it. You should also wait if you can still bootstrap for a while longer and avoid dilution. And finally, don't try to raise if you don't have a complete, committed founding team.
That feels like a perfect summary of the entire process. And it brings our deep dive to a close. The overarching theme from everything we've looked at is that funding isn't magic. It's a logical process built on strong business fundamentals. If the product, team, and market are solid, investors will find you.
They absolutely will. We've covered the documents, the numbers, the steps, but let's leave you with one final thought. We heard again and again that investors fund founders more than they fund ideas, and they invest in founders they find trustworthy. So if trust is the real currency here, the thing that goes beyond the pitch deck and the cap table, this raises the question. Beyond presenting clean documents and sharp numbers, how can a founder effectively build and communicate the non-quantifiable element of trust during the rigorous due diligence and pitching process?
A challenging question, and maybe the most important one. Something for you to think about as you build your own funding strategy. Thank you for joining us for this deep dive. We hope you feel more informed and ready for your next big step.